All right, hey guys, welcome to Passive Piggy, the show where we talk about all the ways to generate passive income. Today's guest, David Meyer, is the head of real estate investing at BiggerPockets, where he's responsible for analyzing housing data, economic trends, and investing tactics to help investors make informed decisions. He regularly shares his findings as the host of the BiggerPockets real estate podcast, On the Market podcast. He's the author of Real Estate by the Numbers, Start with Strategy, and the Real Estate Strategy Planner. We're really excited to have him on. Thank you for coming on, Dave.
Mike, thanks so much for having me. I'm super excited to be here.
Yeah. So would love to hear a little bit more about you. How did you get into real estate? Can you talk a little bit about that?
Yeah, absolutely. So I got into real estate somewhat on a whim back in 2010. I had graduated college undergrad in 2009 and was having a hard time finding a job. I was waiting tables and making decent money, but I had a lot of time on my hands. And at that point, I was living in Denver, and I had a friend who was making all this money buying real estate because it was pretty cheap back then in 2009. And I thought, if my friend could do this, I could probably do it. And I dove in and didn't have a lot of money at the time, but was able to partner with three other people and was able to land my first deal after just a couple of months of searching. And I've been doing it ever since. And it's been a great way for me to sort of as a side hustle, passive income, whatever you want to call it, which I'm sure we'll get into. But it's been a great asset class and endeavor for me personally.
That's awesome. So, I think this is the part where I think a lot of people will find interesting is because I think a lot of people are in the shoes you were in of don't have too much going on, don't know exactly how to get into real estate. You of course had your friend to like kind of prompt you into it. And I kind of, it's a pretty big community, the subreddit, and it's people from all walks of life. But I kind of like to divide it up into quadrants of, there's a time axis and a money axis. Some people have money, some people don't. Some people have a lot of time, some people are really busy. But, maybe just to make it simple, like two of I think a good number of people are people that have, a decent amount of time but really no money. People that have a lot of money but no time. They're just really busy. So in the example that you gave from your personal story of like, hey, you didn't have a ton, like you're making okay money, but not like how did you go from that to like making your first investment? I think a lot of people would be curious.
Yeah, I totally agree with you about those two axes. I talk about this a lot on the podcast too, that like you got to just figure out what you have because people want to build a portfolio, whether it's real estate or something else. Everyone wants to build a portfolio or some stable sources of passive income. You got to bring something to the table. You can't create something out of nothing. It's impossible. Capital is one thing that you can bring to the table to use as your building block, but time, or I would even argue skills that you have accumulated from somewhere else, are also things that you can bring to the table. And for me, at the beginning of my investing career, it was time. I had some time and I had a lot of drive at that point, and frankly, not a lot of other commitments that I had to go do stuff. So I used what I had, which was time, to source my own deals. I used to drive around Denver. I actually would bike around Denver a lot and look at just lots of deals, try and study the neighborhood and understand it really well. And by doing that, I was able to find what I believe was a great deal, was a fantastic deal. And I found a property that I can then go bring to people who have capital.
Yeah.
And because I had done the legwork, people who fall sort of in the other, the opposite quadrant that I was in, to your point, Mike, that these are people who maybe didn't have the time to run a real estate business, but had a lot of money. I could present them and sort of showcase a mutually beneficial relationship where I'm going to take care of the property. That was sort of what I did. I found the property. I was going to manage all the tenants. I was going to do the property management. In exchange, I was going to raise money from them for the down payment. And we created sort of a structure on top of that. But at the simplest level, that's what I did. Is I found something that I had that other people didn't, and I traded it essentially for something that I didn't have, but other people did. And that created this sort of mutually beneficial thing that allowed me to get my first deal.
That's awesome. Is how did you even know like how to structure that deal? It sounds like you're basically a deal maker there. Like, how did you even know what like good numbers to use as far as like how you structure that?
That's a great question. I just asked a lot of people. I was just hustling at this point in my life. So I was waiting tables and I was also cold calling for a commercial real estate broker at the same time. So I asked her for just some advice and I just asked around. At this point, I didn't know BiggerPockets existed. I did not go on Reddit. I was just kind of flying by the seat of my pants. But I knew enough that I had to offer a lot of upside to these people for taking a chance on me. And so the way it actually got structured, I'll just tell you, is like we split the deal 25% for everyone. But I didn't have enough money for my 25%. So I then borrowed that from one of the partners at as a secondary loan. And I used the money I was generating as the property manager to pay off that secondary loan. And so we can get into this if you want to get into real estate. Like it's appealing to try and get everything on the first deal, but I just kind of wanted to get into the game and I was willing to sort of get really creative in this. And I knew that I had to give that secondary loan better terms than that person could get at a bank. It had to be higher than our mortgage rate. And so it actually, my mortgage rates around them were like 4.5%. So I wound up paying, I think, 7% on that. So they were getting a better return on their capital for taking that additional risk on me. And we all went into it because these are people I know, these are friends and family. So we all went into it and it felt sort of just right to cut it up 1/4 each. And even though I was doing all of the work, I was getting paid as a property manager. That felt fair to us. And honestly, we never had any issues with it. It worked out well for everyone.
That's amazing. Was there any point in that process? Because I know for me, like every project I've been involved in, whether it's real estate or online or whatever, like there's always some challenge with the deal or some hiccup or something goes wrong. It's very rare that everything goes smoothly. Was it like that for you, or did everything just
Well, things always go wrong in real estate. That's just part of it. Part of managing a property or managing a business, excuse me, is that things go wrong. So I wouldn't say they went wrong. I would say there was a predictable amount of maintenance and repairs and things that happened in the deal. But actually, between partners, it was totally fine. Nothing ever came up there. And I attribute that to because someone gave me some advice and it was very wise to like really do it by the book. And I got an operating agreement created. We all talked about what happens if someone wants to sell, what happens if someone needs liquidity, what happens if someone dies, and did the whole legal thing. And that really worked out well because I think 6, 7 years into the deal, one of the partners want to sell and the other one want to sell. So what wound up happening was two of us bought out the other two from their equity, but it was all laid out 6 years before that, how we were going to handle that. So there was no issues. Everyone just agreed. That worked out well. Two partners walked away with a lot of money. The other two, bought them out and that worked out well for us. So there really wasn't any issues because I really think it's because we thought about it ahead of time and didn't just say like, oh, we're all friends. We all know each other. Like, it's going to be fine. It might not be. So just go through and I sort of call it like a prenup for your partnership. Like you should just think about that ahead of time and just figure out worst case scenario, what you're going to do.
yeah, some of the best advice that I think I've ever heard as far as these types of deals go is, go through all of those sensitive situations when things are good. Because
That's right.
if things go bad, like that's the wrong time to negotiate, like start negotiate.
Exactly. Yeah. And so I'm sure there are still ways it can go wrong, but I think if you do that upfront work, it really protects yourself against that partner risk.
Yeah, that's awesome. So obviously the your involvement in that is and I'm sticking on this topic just because I know a lot of people are gonna be interested. But just to spend one more minute on it, your involvement in that obviously wasn't passive at the time.
That's
You
right.
put in a lot of legwork, you found the deal, you were biking around Denver. But I guess the question is, when do you think it became passive, if it did at all? And then on the flip side too, I think for your partners, it was probably pretty passive for them, yes?
That's right. Yeah. And I know everyone loves to debate, is real estate passive or not? There's a spectrum within real estate. There are very, very passive types of deals like syndications or investing in debt funds or stuff like that. Super passive. Operating a rental property, I wouldn't I would say it's more passive than working a W-2 job or a 1099 job most of the time, but it's definitely not passive. You have to put effort into it. So I think it really does depend on each individual circumstance. As you said, Mike, it wasn't passive for me. I was there a lot, and I was there putting in a lot of hours because I also wanted to learn the business. And so I was, when the tenants would call and have a problem, I would go and try and figure out things for myself, how to fix a certain situation, how to just talk to a tenant when they're upset about something. I put in that time because I wanted to learn the business. You don't have to do that. You can hire a property manager and make it more passive. So it wasn't passive to me until I moved to Europe in 2020, 10 years later, was when I finally started outsourcing a lot of my property management. I self-managed my whole portfolio for 10 years while I was living in Denver. And I got better at it though. So like if you're starting out your first deal, you're self-managing, that's probably one end of the spectrum on how involved you need to be in a real estate deal. But by the time I left Denver, I was managing, a bunch of units, a bunch of properties, and it was taking me probably a fraction of the time it took me to manage that one property right at the beginning because I knew who to call. I had a team built out. I had a good network built out. I wasn't panicking anytime anything went wrong. I was able to handle things calmly. And so, although it did get more passive, I still have to do some stuff about it. But I operate a pretty diverse portfolio at this point, which a bunch of different types of real estate. But I have a rule for myself where I won't spend more than 20 hours a month on real estate. That's kind of my thing because I work full time. I have other personal interests, I have other professional interests. And I always recommend people who say, real estate's not passive. It's like, well, you can make it passive if you're disciplined about it. And that's the way I sort of enforce this discipline on myself is say, like, it's 20 hours. So if I'm going to buy a new deal, it has to either be really passive or I have to sell a property that's a pain in my butt to make room time wise in my portfolio for those future deals. So that's kind of how I think about it.
Mm. Yeah, I love that. And I think your journey into this is a good maybe example for those wanting to get in. Because I think the way you did it, you kind of really learned by doing and became an expert through doing, through trial and error. And there's really no shortcut around that, I feel. Even if you are in that quadrant of you have a lot of money but no time, I'd love your stamp of approval on this or not, but I'd assume like even those investors really need some level of knowledge and experience to ask the right questions, to make sure it's a good deal, to make sure that the operator there who's going to manage the property knows what they're doing or some pitfalls.
I do recommend for the majority of people, if you want to get into real estate for the long term, which should be everyone, because real estate is not a good business if you want to be in it for the short term, in my opinion. So, if you want to be in it for the long term, I think most people should start by buying their own property and operating it at some level. And there's like hybrid models, right? You don't want to answer maintenance calls. You don't have to do that. But like just get into it a little bit and learn what it takes to find a tenant. Go, even if you hire a property manager, when a tenant turns over and you need to get it ready for the next tenant, go walk through it with the property manager and learn what things that they're doing and why those expenses come up. Because if you're just looking at your bill from your property manager, you'd be like, what are all these turnover expenses? Like, I don't want to pay for these. But if you go and walk it, you'll see, hey, the last tenant, normal wear and tear, you got to put some paint. You want to make it a nice, livable, comfortable, great situation for your next tenant. And so you need to put some money into that. Just things like that really do help as you become more passive. Because what I advocate strategically for most people is start more active and then you sort of like go on this continuum towards passive. That's what I've done in my investing career. I still buy active deals, but I've gotten it to where I'm about 50-50 at this point. And I think I am comfortable investing in other people's deals because I've done enough myself to know what could go right, what could go wrong, and what questions to ask.
Yeah. And you understand the risks of certain types of deals, I imagine.
100%. There's risk in every deal, and in some ways, I think a lot of people say there's more risk investing in other people's deals, and that's true depending on the circumstance. But I think that acknowledging those risks and seeing where things can go wrong is probably the most important part of investing passively. I was actually talking to someone at a meetup the other day. They were trying to, ask me if I'd invest in a deal. And I said, people who invest passively think about this very differently than people who are super active. If you're an active solopreneur, you're just out there hustling, like you think about only upside, and you kind of have to, right? You have to just like be like, I'm going to go grind this out. I'm going to make this work and look at this light at the end of the tunnel. I can make tens or hundreds of $1,000s a year if I pull this off. That's how I think about my active deals. On my passive deals, though, I'm like, how are you going to lose my money? How are you going to screw me over? Like, what could possibly go wrong? I just mentally, you have to think about it totally different. And I have had enough exposure to most of my own deals and just being a part of the real estate passive investing community in the last 15 years. Like, I've seen enough of it to understand the risks and make decisions eyes wide open. Sometimes they might not go well, but at least I'm okay if I lose money on a deal, as long as I identified that those risks were real ahead of time. The thing that I really want to avoid personally is like, oh, I got blindsided by a risk that I totally missed, and that's why I'm losing money.
Yeah, understandable. Let me ask you this, because I know this was a big trend a few years ago in real estate. And it was, like you'd have TikToks about it of, hey, I bought this property and I just put it on Airbnb and now there's big cash flow and now so I mean I've seen that die down a bit. What's your opinion on the Airbnb, like that type of investment?
Well, I'll tell you, my Airbnb is probably my worst performing investment if you just want to know. I don't think it's dead. I do think that industry faces a lot of challenges. It wouldn't be my first recommendation to most people. And I think there are people who can be great at it, but it's running a hospitality business. It's much more active in my experience. And I only have one, so take this with a grain of salt. But in my experience, just running that one property is a lot of work. And it requires constant tweaking of your business model, of your strategy, your pricing, your furnishing. Honestly, the strategy of owning a rental property doesn't really change. Provide quality housing to good tenants. Like that's it. And so I think what happened in is what happens in any new technology and any new industry emerges is there's an inefficient market. And that means that early adopters in that market are going to be able to get outsized returns. And it was great for a while for a lot of people. But when money is being made, markets get efficient pretty quickly. People notice whether it's Wyndham buying up tons of single family homes to rent out, or average run of the mill people wanting a second home and thinking, oh, I can subsidize my vacation home by putting it on Airbnb. The demand for these properties just went through the roof. And as a result, what we see now is supply in short-term rentals is outpacing, supply growth is outpacing demand growth. And so prices are going to go down. And we're seeing that. I'm seeing that in my own rental. Luckily, I bought at a good time, so it's still making money, but like it's not growing in the way I would want it to. And I just know people who have rental portfolios of short-term rentals who are kind of moving out of the space. They're either buying old motels or they're going into multifamily. And I still think it works if you find great properties and are really good at running a hospitality business. But I think it's difficult to scale right now.
Yeah. Yeah, that totally makes sense. And it's anecdotal, but even personally, just with people that I know, there seems to be a bit of like the Airbnb fatigue. You get charged cleaning fees and all that, and then I'd rather go to a hotel now. So, like, now that it's kind of proliferated and it's gone through that kind of hype phase, now it's just maybe normalizing a bit back to a level where it should be.
Yeah, it's funny. People will probably get mad at me because I'm a real estate investor, but like I prefer to stay in hotels. I don't know about you, but unless I'm going on like a group trip, I think Airbnbs are great for group trips. That's really fun. But if I'm going somewhere with my wife, I'm staying at a hotel for sure. I just think the average quality has declined, and there was a time when the places you would get, they were all fantastic because it was just this small community of people who did vacation rentals before it proliferated. And it was usually people's primary home or secondary home. And they had a lot of pride in ownership and cared a lot about it. And I think that's not great. And the other thing I need to mention is Airbnb in particular has shifted their own terms of service and policies really to benefit the guests at the expenses of hosts. Like they just announced a new change to their T's and C's, which is like, even if a guest uses a fake credit card, Airbnb takes no responsibility for that. So like they're bringing people on and the host takes 100% responsibility for the guest using a fake credit card. Like there's stuff like that that make it hard to operate the business. And as an investor, we're always balancing risk and reward. And the reward is going down and the risk is going up, in my opinion. And so I haven't even thought about buying a short-term rental in many years and probably won't anytime soon.
Yeah, I actually just heard of an example. I think it went semi-viral of this guy that rented Airbnb and he stayed there for a couple weeks and the bill ended up being around, I think 9 or 10 grand. He wasn't satisfied. Like something went wrong and he wasn't satisfied, but he didn't say anything. He just stayed silent with the feedback. And then he ended up getting refunded the whole thing. Airbnb just stepped in and refunded the whole thing. So I imagine the host is just like, right? That just kind of screwed
Yeah.
up the host.
Yeah, it sucks. And I mean, I have my own conspiracy theories about this because like I think Airbnb knows it's oversaturated on the supply side. So they don't mind losing hosts right now. And they need that steady stream of demand. So they're going to tilt these things in the favor of guests. Their business, they can do what they want. But as a host, to me, again, that just creates a lot of risk.
Yeah, yeah. Changing tracks a little bit. So I'd love to get into maybe some trends. So I think a lot of people thinking to get into real estate are a little trigger shy.
Yeah.
And I say that because they're just uncertain about like where the economy's going, where the housing market's going. Is now a good time to invest, do you think?
I do. I do. I have the same concern. So like I know I am a real estate investor. I do have biases. I work for BiggerPockets. I have biases, but I always say this. I'm not a martyr. Like I wouldn't invest my money in an asset class that I know wasn't doing well just to like, because of my previous career in investing. And so every year I spend time at the end of the year figuring out how I'm going to allocate my portfolio and like how do I want my money in stocks and bonds and crypto and gold and real estate and private businesses. And I keep coming back to real estate as the predominant place to put my money. And I do have other holdings because to me, the potential for income replacement has the best risk adjusted returns. And I know in this community, there are other great businesses buying small properties, doing online work like you do, Mike. Like those are great ways to make more money. And honestly, a lot of them offer better cash flow potential than real estate does up front for sure. But my approach has always been in 10 or 15 years, like I feel almost certain that this business and this business model will still be around. When I look at other industries and other businesses, AI is changing everything. Technology is always changing. These asset classes come with long-term risk that I can't see coming. I have no idea what's going to happen with these things. Real estate has been a business since literally before capitalism. It's been a business for thousands of years. And I feel pretty confident that it's going to still be around when I want to retire off of my real estate. And so, like, big picture strategy, that's why I keep coming back to real estate. So that's one thing. The second thing is real, that affordability is really low in the housing market, right? So, like, if you believe in real estate, should you buy now or should you wait a couple of years? It's very hard to time the market. And so the things that I often tell people is that I think now is as good a time as any to buy real estate. Real estate was in this very unique time in 2010 to 2020, where I call it like this Goldilocks period, where it's uniquely affordable and uniquely easy to get into it. And now we're in a more normal era. And that doesn't mean bad. It just means a more normal era where there's going to be a lot of bad deals on the market. And you need to be a little bit more disciplined about what you buy. we're going back to a time where you can and should and need to buy under market value. You can't just go buy something and pay full market price, because we are maybe in the midst of a national housing market correction. Like, I think there's a good chance that in 2025 we see national prices decline. And that scares people, understandably.
Mhm.
But it's also the time when assets are on sale. And so I think I encourage people to see this as what it is. It's a buyer's market, which means that there is more supply on the market. There are more homes for sale than there are buyers, which means that you as a buyer have leverage. And it does come with risk. There is some risk that property prices will decline a little bit, but I do not believe there's a high risk of a crash happening. And I'm happy to get into that in a minute. But I think there's a chance of a decline. But use your leverage and negotiate. If you think prices might go down in your neighborhood 2%, negotiate till it's minus 4%. And I'm sure people out there are saying, oh, isn't that nice? Like, of course I'd like to do that. Well, the data is there. There's a metric in the housing market called the list to sale ratio, which basically measures how much over under asking price things are going. And in recent months, it's gone from 102%, so people are on average paying 2% over, down to about 99%. And this is happening rapidly. And so you can start to negotiate and get better deals. And to me, that's a real opportunity, because I want to buy great assets that I'm going to hold on to for a long time. And if I can buy them for a little bit cheaper, that's great. The one thing I do hate is this idea of date the rate and marry the house. And I do not agree with that at all. I would never buy something assuming that mortgage rates are going to down. And I highly recommend people do not do that. That is unnecessary risk on something you do not control. So I really recommend, if you're going to buy real estate, make sure the numbers work today, negotiate, and then buy real estate. Like, I'm still buying real estate. I'm actually gearing to buy, like sort of gearing up to buy more in the second half this year, because I think there's a great window. But you do have to sort of mitigate some of the real risks that are out there.
Yeah. Do you recommend any type of real estate for maybe a beginner investor, like single family, like duplex?
I think the sweet spot for almost everyone who's in sort of the passive investing mindset is 4 units or fewer. And that's because, if you're unfamiliar, anything that's 4 units or fewer, so that's a duplex, triplex, or fourplex, if you buy that, you are eligible for residential financing. This is super important. This means that you can get long-term fixed rate debt, which is one of the most important benefits of real estate investing. You can lock in an interest rate for a long time. And I know people think a 6.5% mortgage is high. It is not historically. And if they come down to the fives, like, I'm going to try and lock in as much of that long-term debt as I can, because that's super valuable. You'll probably get a lower interest rate too. There are also all sorts of terms and provisions and homeowner assistance programs that you are eligible for if you do 4 units or fewer. So I really recommend that to most people, because I think getting into that commercial space, which is 5 or above, managing 5 units versus 4 units, almost no difference. But the debt structure changes. You're going to a commercial loan, which is often it has a balloon payment on it. It's an adjustable rate mortgage, which, if you really know what you're doing, you can do. But for beginners, I really think the stability of a 30-year fixed rate debt instrument is one of the great benefits to being a real estate investor. And I don't really see a reason for any beginner to look anywhere else.
Is there a common mistake that a beginner makes when they're investing in a property and I don't know if there's something specific to multi-units or not, but I'd love to.
No, I think honestly, it's not that hard. Like, I had no idea what I was doing when I was just getting started, and I was able to figure out. I think there are two common pitfalls that I see with people getting started. The first is the analysis paralysis thing, where people really, they look at a million deals, they never execute one. My recommendation is come up with a simple criteria for what a good deal is. And when you find it, go for it. Because otherwise, you're going to agonize over, like, what is the best deal? Is another one going to come out next week? I will share with you my criteria for 2025. It's basically, what I look for is it absolutely has to be cash flow positive after stabilization. Stabilization is this term we use in real estate that talks about, like, once you bought the property, you fixed it up a little bit if it needs it, and got rents up to fair market value, right? So once it's like performing the way you want it to perform, it has to cash flow. And that brings me to the sort of the second pitfall. people oversimplify the cash flow formula to just being like, my mortgage payment's $3,000 or $2,000. I'm getting $3,000 in rent. I'm cash flowing. No, you're not. That is not cash flow. Cash flow is after you separate all of your operating expenses. So these are obvious things like, of course, your debt service, that's your mortgage, but interest, excuse me, insurance and taxes. Yeah. Maintenance and repairs. Most people get those things. What about vacancies? That's actually an expense that you need to put in your budget. What about turnover costs when a tenant leaves? What about capital expenditures, which are big things you should be saving for, like a water heater or a new roof? A lot of people dunk on real estate being like, oh, you have all this cash flow until, your water heater breaks. Well, if you aren't accounting for your water heater breaking, you never had cash flow and you're underwriting your deals wrong. Like the people who say that don't understand what it means to actually run a successful real estate business. So that's like the major thing I really recommend people looking at is like learn how to calculate that, because if you can cash flow a deal in real estate, you will be successful. Like it's really never not been true historically speaking, because the only way you have to give up your property or you can lose it to the bank is if you stop paying your mortgage. And if you are cash flowing the way I just described it, that will never happen. If you actually underwrite it well, you will always have the option to decide when you want to sell your property, when you want to make these changes. And that gives you an enormous amount of freedom and control over your returns. And so I think that those are sort of like the two major things, the analysis paralysis
Mhm.
and the cash flow. I will just go back and say, like, so that cash flow deal at year one, the end of stabilization, that's a main criteria for me. The second one is it's got to get a 12% annualized return or better. Stock market's 9 to 10%, and real estate's not as passive as the stock market. So I need a return to justify that increased
Mhm.
time. So I set that at 12%. And that's for low risk deals. For a high risk deal, it's probably 15 to 20%. And then I need to have upsides. Like I need there to be in the path of progress. I need to have a strong belief there'll be rent growth, or there's going to be zoning where I can add more units or add more add more bedrooms, that kind of stuff. And so I set that criteria. And as soon as I've saved enough money to buy those, I just keep buying those deals. And so like, I think coming up with that system is mentally helpful to get you over some of the like hurdles that early people face.
Mm. And is there, I imagine the crux of the whole thing is to have a successful deal is just finding those deals, finding the properties that will cash flow. Is that really hard? Do you encounter, according to your formula, one every month, or how does that process work for, maybe a beginner?
It is hard. I will say that right now in 2025 is one of the harder times in my career to find deals, but it's easier than it has been in the last 2 or 3 years. So I actually think the pendulum's kind of like starting to swing back in the other direction. 2023, 2024, I didn't buy a lot. It was pretty hard to find deals. And it is very, very region dependent. So if you are living in Seattle or the Washington area like Mike and I do, if you live on the West Coast or in the Northeast, it's going to be hard to find cash flow that is on market and is stabilized. So what I mean by that is like if you go on Zillow and look for like a nice looking property, you're probably not going to find cash flow. That's pretty difficult right now. So you have a couple of options. One is to get really creative with deal sourcing, looking for off market deals. That's not passive. I don't do that stuff because it's just too much work for me. And so, given the context of who we're speaking with today, I wouldn't recommend doing that. So, I think the two other ways that you can do it are to get more involved in your actual deals and do renovations. That's a fantastic way to make money. I mean, it is a proven way, whether you're flipping a house or renovating a rental, you build equity and you can increase your cash flow. It does take more time. Of course, that pushes you more towards the active end of the real estate investing spectrum, but it is short term. If like just say you buy a duplex and you fix it up, that's 3 or 4 months of your life. And then you're setting yourself up to have all this passive income or more passive income for years to come. And so that's up to you if you want to do that. The third option is to invest in a region where this kind of deal is just more plentiful. So I would call out the Midwest, mostly being as the area that you can do this. And so you can buy long distance. I do this myself. I think it's a very good strategy for people on the coasts because in Michigan or Illinois or Indiana or Wisconsin, you can find in nice communities that are growing, good tenants, you can find cash flowing deals on the market that are stabilized today. And so I think those are three good ways that people can consider sort of just broadening what they're looking for. If you happen to live in the Midwest, just go buy in your backyard. That's great. Or some areas of the Southeast. But it's going to be very dependent on where you live in your region.
For a long distance investment, the idea that makes me a little bit nervous. Do you always go physically check it out at least?
So yes and no. It depends. I always go check out the market. I have never bought real estate in a city that I had never been to for the express purpose of evaluating it as a real estate potential market. And so I've done this a few times. I'm actually leaving tomorrow to go do this again, to go look at markets and evaluate them. So I go and I interview property managers, I interview real estate agents, I'll meet with local investors, and I'll try and get a sense of the city. And I can talk more if you care about some of the criteria for that. But then once I've done that, and if I have someone I trust in that city, I've bought properties sight unseen. And that's not for everyone. Know enough, like you said, I've been around this enough to know what to look for, the red flags. I have the property manager in place, I have the agent in place, I have the contractors in place. So I'm willing to do that. That's not for everyone. But I really recommend going to the city before you invest anywhere. And I think for me personally, this might change per person, but for me personally, I think it's more important to evaluate the city in person than they evaluate the deal in person.
Why do you say that?
Because well, there's two things. The only reason to invest long distance is because the city itself can offer you something that where you live doesn't. And so that's my main criteria. Like I invest in the Midwest because I look for markets that have a mix of appreciation and cash flow. And the other places I invest, like Colorado, Washington, heavy appreciation markets, very difficult to get cash flow. So I need cash flow. Number two, I need to be able to understand that market. I went to, just no offense to San Antonio, I went to San Antonio, and it's a very sprawling city. It's huge. I didn't even know until a couple of years ago. It's the eighth biggest city in the country. It's massive. I just couldn't figure it out. I couldn't understand where people would want to live. I couldn't understand where infrastructure was going in. I couldn't understand where the best quality of life was, where the jobs would go. It just didn't make sense to me. Still a great city. People make tons of money investing there, but to me, it didn't make sense. Columbus, Ohio has been a boom city for investors. I went there. I was just like, you know what? I wouldn't live here. I don't get it. Like, it's not for me. I go to other cities in the Midwest and I can instantly sort of have this feel for them where I'm like, I can see the blocks I want to invest in. I can see the neighborhoods I want to invest in. It's small enough for me to understand. I also literally want to understand how difficult it is for me to get to these markets. Because even if I don't see the deals before I buy them, I do go visit them regularly. I want to make sure that I can get there in a reasonable amount of time, that they have a good airport. Like for me as a long distance investor, that's the kind of stuff I really care about. And maybe this is different for me because like I sort of have an expertise in deal analysis. And so I feel like by talking to my agent, taking pictures, videos, running the numbers, I can get a good sense of the deal itself, the house itself, as long as I understand the neighborhoods and the markets.
Yeah, because the house is just the house, no matter where it is. So you're talking about, what's around it, like what's going on in the city around.
That's right. And for me, when I buy long distance, I am looking for pretty easy deals. Like I'm looking for stuff that's new or built most of the time that doesn't need a lot of renovation. If I were doing heavy renovations, I would not recommend the strategy. Like if you're going to go take something down to studs, you need to go see that in person, like for sure. What I'm doing is like I'm putting paint on it, I'm renovating a bathroom or a kitchen, fixing up the yard, these kinds of things. Like that's kind of stuff you can manage remotely. It's not really that hard. And if it's built in the 60s, you're not going to have knob and tube wiring, you're not going to have some of these challenges for older properties. And so it really, for me, I will buy these sight unseen properties, but it has to fit in this buy box that is disciplined about like that allows me to lower my risk. I wouldn't go buy a flip of a 1905 home without seeing it first.
Yeah, makes sense. I do want to key in on something that you said that I'm really glad you said, which is the San Antonio example of it just didn't make sense to you. There's plenty of successful real estate investors there, but it just didn't make sense to you, so you decided not to go in. And I think that's really important for everyone. And I think this applies across any investment, whether it's real estate or stock or anything, because it's really, I think a lot of people get tempted, and I've been tempted before, and I've kind of fallen into this trap of there's a hype around something. And you kind of want to go with the hype. And so even though you don't fully understand it, you just kind of put your money there. And I think that's one of the fastest ways to lose money. So even though other people are enjoying success in whatever area, if you personally don't understand what's going on, I think it's an easy way to lose money.
100%. Yeah. It's, you know, this is partially my fault. As an analyst, I put out all these like lists, like best cash flow markets, because it's fun. I like doing it. It helps people narrow down where they want to invest. That's the purpose of these things. Like the top 10, all of the 10 are going to be good. Don't obsess that like, oh, everyone's talking about Indianapolis. Like I got to go there versus like one of these other ones. It's like, if you understand the metrics, go the place one that you have a good vibe for. I know it sounds silly as an investor. I'm like the data guy, but the vibe matters to me. I don't want to invest somewhere that I don't want to go. Like, why would I invest in a city that I hate going to visit? Like getting on a plane, it's not going to be a sustainable business model for me. I want to invest places I like, where I like my property manager and my agent. And if I go twice a year and hang out for 4 days, I have a good time. Like that makes the business sustainable and fun and makes you want to keep going. And so I really recommend thinking about the vibe. And honestly, all things being, most of these markets, if I say, if you picked 10 great solid fundamentals markets in the Midwest, the determinant of your performance is going to be your team. It's going to be where you have the better agent, the property manager, and and contractors. So I would decide more on, you know, if the vibe's good, the fundamentals are good, and you have a good team, I'd go there rather than being like, this market has a 0.05% better cash on cash return. Like that's not going to matter long run. What's going to matter is like execution.
Makes sense. Switching gears a little bit. Now, of course, the past few years, AI has been everywhere.
Yes.
What, like, how does AI help a real estate investor?
Great question. And this is something we're talking about and thinking about a lot at BiggerPockets. But right now, not that much. But I think the potential in the future is going to be really interesting. I hear a lot. Actually, I literally right before this went and got a haircut. My barber, he doesn't know what I would do for a living. And he was telling me how he was asking ChatGPT for markets to invest in because he wants to buy a second home. That's great. ChatGPT specifically, the data is kind of old and is not always great. So I really recommend double checking all of that work. But that's just a matter of time, right? You know, like 6 months from now, I'm sure it's going to be great. So I think it's going to be really cool for that. What I would recommend for people using AI for these types of things is to work on your prompts, because if you just say, like, what's the best investment strategy? Like, there's no best investment strategy. So I think the cool thing about AI is like, if you say like, hey, my name's Dave, I have this job. My goal is to make, you know, get fully passive income in 12 years. My risk tolerance is medium. I have $40,000 in the bank and I have 20 hours a month to give to my real estate investing. What would you recommend? Like that kind of thing could be cool. And so I think those kinds of things will be really helpful in like personalization of strategy. And then, you know, the MLS is such a pain. I don't know how much you listeners of this follow, but like all the rules with NAR and Zillow and who's allowed to say what, it's this nonsense. So I don't know when or where it will happen, but eventually we will have more like analysis of on-market properties. And we actually have a tool on BiggerPockets. It's free. People can use it. It's called Bigger Deals, that allows you to do this. But I think more and more that's going to become more ubiquitous, where the deal analysis is less of a premium. And the ability to source good deals and execute on them is really what's going to what's going to differentiate good investors from bad.
So, are good deals as in just finding off-market deals, or what do you?
Yes, that. And I guess the one thing I should explain is that when you look at, you know, our tool and Bigger Deals shows cash flow, which is awesome, but it's for the way the property is in its current state, where so much of real estate investing is finding hidden potential in deals that isn't there. whether that's zoning upside or, figuring out a new layout that's going to make it more valuable or adding a bedroom. And so just being able to spot those opportunities, maybe AI will be able to do that in the future. I do think we're a ways away from that. We've seen Zillow and Open Door pour millions and millions and millions of dollars into trying to be able to do that through their iBuyer models that completely failed over the last couple of years. And I should mention they failed during probably the easiest time in history to succeed in that kind of business model for like fix and flipping, and they failed. AI has come a long way even since then, and it will continue to evolve. But there is this like tangible human element of real estate that I'm sure I will conquer at some point, but it does feel that's a little bit further away. And it's like a skill set that I still think humans need to develop to if they want to be successful at real estate.
Yeah. Yeah, I mean, I can automatically see a bunch of the community members just thinking of just for real estate, how AI can play into it. Oh, I can make like an AI agent that will go and find deals for me,
Yeah,
or you know, just stuff like that. And I think there, I would assume there is probably an opportune time for that. Like you were saying, like with the Airbnb, there's a time when the market's inefficient, right?
Mhm.
If you get into it at that time, you can, benefit from that. And I feel like the times may be here or coming soon where there is going to be a market inefficiency versus the tools that we have. Like if
That's
there
a good point.
are AI tools that can take advantage of that, and there are players in the market that aren't using that, then there's probably a time period when, you can benefit from that.
That's absolutely true. That's a very good point.
Okay, well, this has been awesome. Is there anything that I missed that the
Just
viewership?
one thing I just always want to circle back to people asking about the timing of the real estate market. And I think I just want to be clear because I spend a lot of time looking at this and maybe it's helpful to people that even if there is a correction in the housing market, that does not mean there's a housing crash. And I am a millennial. I have trauma like we all do from the 2008. I think for many of us who became adults around that time, like it feels like housing correction equals this like massive 20% drop. When you look historically, that has happened one time since the Great Depression, and that was in the financial crisis. And normally, what you see is modest corrections in the housing market every 7-ish years, 7, 10 years, whatever it is. And prices go down and then they keep growing. I, of course, have bias about this, but I spend a lot of time thinking about this, and the data supports this as well. For a real crash to happen, you need to see prices to come down and you need this thing of forced selling. You need people to not be paying their mortgages. And that's not happening. If you look at mortgage delinquency rates, they are very low. They are still below pre-pandemic levels. They're below where we were in 2019. And so even if you see the housing market go down a little bit, I don't think at this point there's any reason to panic and think this is going to be some huge calamity. It's probably going to be what normally happens. Prices fall 1, 3, 5%. Then things swing back in the other direction and they go up over the long run. Of course, things can change. There can be black swan events, but I just want to be like upfront with people that like the data does not support what you might be seeing in either here on Reddit or other places and the media, that just because prices went up 50% does not mean that there's going to be a crash. We do have an affordability crisis in the country. That doesn't mean the price is going to crash. Like what has to happen for the crash is delinquencies on mortgages, and that's really not happening. So just wanted to share that with people if it gives them some comfort about the idea of real estate.
Yeah, for sure. Yeah, like I said, I think a lot of people, including myself, are a little weary and just uncertain, right? Of like, hey, is this good timing? Like maybe it's really bad timing. So
For
that's
sure.
context.
Yeah, I think in a lot of markets, prices will decline this year. So keep that in mind. But that doesn't mean a crash. I think a lot of people see that and say, hey, prices went down in 10% in one city in Florida, the whole country's crashing. If we had another hour, I can explain to you the many peculiarities of Florida in particular and how that's not spreading, but hopefully you get my gist.
Yeah, yeah, certainly. And just to add my own thought to it also is if I think back to the whole period too of the last 20 some years, to me it seems like where like it's what Warren Buffett said, right? Like be greedy when others are fearful and be fearful when others are greedy. And if I think back to the 2007 and 2008, I bought a condo then. Like it was very
Yeah.
like, hey, everyone buy something. Like there was greed, there was hype around real estate. And that's when it crashed. And now there's fear, there's concern over it. And it seems like, oh, maybe Buffett's advice applies here where it's a great time to buy then.
Yep, absolutely. And I think that's a really good point. And people always say like, oh, I started in 2010, like that's so lucky. It was not obvious to buy back then. All of that is in hindsight. People thought I was crazy to buy in 2010. And I'm not saying this is the same situation because in 2010, things were way more affordable than they are now. And I think that's kind of what feels off to people is like it's so unaffordable and prices went up so much and we're starting to see a correction. Is this like going to be this massive downfall? Well, that's always possible. Again, the data and the fundamentals of the market don't suggest that that's a likely scenario.
Yeah. And those of the viewers that are maybe younger and that don't remember that period, they remember probably the pandemic. 2020, I think around March was when the lockdown started happening. And I remember there was a panic in the
Oh, for
market,
sure.
estate market. And I remember a bunch of people talking about, wow, like I need to sell my house like right now before the big crash. And
Hmm.
there was a lot of fear and uncertainty then. And then what happened? Like nothing. It actually started growing really rapidly since then. So actually, if you invested then, you're in a really good place now.
Yeah, absolutely. That's exactly right. And obviously, every time is going to be different. Every market cycle is going to be different. But I would encourage people if you're fearful, like if you I'm allowed to like plug my podcast on the market. We talk about real estate data twice a week on that. If you want it, it's a free thing to listen to. But I bring on economists from all walks of life to talk about the housing market. And so if you're interested, not just in my opinion, because I obviously have my own opinion, but what other people think about the housing market, you can check that out because we are always having people come on and talk about what's different from the last crash, what's different from COVID, what's similar, and how you can sort of extrapolate that and use that in your own investing.
Yeah, that's excellent. Speaking of that, where can people find you if they want to find out more about you and about Bigger Pockets and about your different guests?
Yeah, for sure. So I host the Bigger Pockets podcast and the On the Market podcast. Those are great ways to find me. We share free information all the time. We have great guests on the Bigger Pockets podcast. It's more investor stories, talking about how people have done it, how they're structuring deals, a little bit more tactical. And On the Market is an econ data show. We talk about finance, we talk about macroeconomics, and how it applies to the real estate investing industry. So those are two shows, and personally, you can always find me on biggerpockets.com. We have our own message boards and stuff that you can check me out, or on Instagram where I'm at the Data Deli.
Awesome. Well, it was great to have you. I thought this was a really valuable conversation, and I hope everyone else enjoyed it too. Thank you, everyone, for listening in. And remember, passive income is not magic, it's math, it's mindset, execution. So keep compounding, and we'll see you next week.
Thank you.